Well, welcome, and thank you for attending. Hopefully you can hear me loud enough. My name's Nate Zeller. I'm the Chief Investment Strategist here for Secured Retirement. So I want to thank you all for coming to hear our thoughts on the market, a little recap on quarter three and the outlook for quarter four. Before we get started, we do have to go through our disclosures that these opinions are subject, and I highlight the word opinions. These are my thoughts of Secured Retirement, and nobody else's. They are subject to change without notice. The markets change quickly. These also are not intended to be individualized investment advice. So if any of you would like to discuss your individual situation in further detail, please let us know. We'd be glad to sit down and do that with you. So our agenda, well, like I'd said, we're going to review quarter three in the markets, mostly the stock market. We'll talk about some of the other markets as well. We'll get into our outlook for quarter four, kind of what we're looking at going forward. We'll talk about some of the portfolio positioning for the in-house managed accounts that we have here that some of you are already invested in, talk about what we've done recently and kind of what we're looking to do going forward. And then obviously there's Q&A, but along the way, don't hesitate to stop me if any of you do have questions or comments that you want to make. A quick recap of the market. For the quarter, the S&P was up slightly. That's the 500 largest stocks. And we'll get into a little bit more on that here in a minute. It's had a really good run year to date in 1 year. If you think about where we were a year ago coming out of the pandemic, it's really done well. The Russell 2000, which represents small cap stocks, so those are smaller companies, did not fare so well during the quarter. There was a pretty big pullback in the small cap space. You go back a year and they've done extremely well, which is to be expected when you're coming out of a dip like that. Generally speaking, small cap stocks lead the way, but they have pulled back. There was some uncertainty going on. We look at what affected the market. We'll talk about this more here in a second too, especially around the fears of the COVID, the increase in cases with COVID and the Delta variant. And I think that had a bigger impact on the smaller cap stocks versus the larger cap. The foreign markets, so the MSCI EFA was down slightly. The emerging markets were down quite a bit, 8%. And the reason for that primarily comes back to coronavirus, where a lot of emerging market countries do not have it well contained. They're very slow to roll out the vaccine. So I think that had a very large impact on the emerging markets over the quarter. The Bloomberg bond aggregate was flat for the quarter, and it's down a little bit. We're going to talk about bonds here in a second. Historically speaking, people have used bonds in their portfolios as a hedge against equities. They use it for a couple reasons. One is a hedge to reduce volatility. Another reason is for income. And we'll talk about this more, that those things are not necessarily the case any longer and probably will not be going forward. Gold did not fare so well either. I bring that up because in a lot of people's minds, and we've received a lot of calls on this, people think that gold is a natural inflation hedge, and it really has not proven to be, especially this time. Goldman Sachs also did a recent study where they went back and they studied times of inflation and which did the best, and it came out that stocks were the best hedge against inflation. And every time period they looked at, that gold was only a good hedge against inflation about half the time. There are other reasons to hold gold as well. I'm not saying it shouldn't be held, but it's not necessarily the best hedge for inflation. And then lastly, oil. Everybody's aware of what oil prices have done and how they were at zero during the, right when the pandemic hit, and they've come back considerably. Natural gas is one I didn't put up here. Natural gas has really spiked in the last month. It's pulled back a little bit, but I'm sure most of us will see that in our heating bills here this winter. As far as the S&P goes, to dig into it a little bit deeper, July and August were pretty decent months. When you think back historically speaking, that the S&P 500 returns on average 8 to 10% a year. This is going back to the beginning of time, almost 1920s anyhow. So if you're getting 2% a month, you're well ahead of the average. So things look pretty good. August was the 7th consecutive month of positive returns, so things looked fine. Then September hit. And that's why I have this highlighted in red up here. And it was flat out ugly. That was a bad month, our worst month since March of 2020. So we ended up the quarter, slightly ahead at about half of 1%.
What factors push the S&P down?
That's what we're going to look at right here. Good question. Thank you. You set me up perfectly. This is perfect. Thank you. The increase in COVID cases from the Delta variant, it's not necessarily the increase in cases. Everybody's worried about more lockdowns, which we saw in some foreign countries. I don't need to make fun of our friends in Australia and New Zealand, but you hear about where they were locking stuff down when there was 100 cases or something crazy. And there was a lot of concern about that happening around the world and here in the US. I think what's happened now is, we've come off that peak. Minnesota's a little bit different. We seem to be a bit of an outlier, but the rest of the country seems to be over the hump and the number of cases are subsiding. I also think politically they found that it's very unpopular to completely lock things down. To wear masks is one thing, but to shut down businesses and restrict the number of people and social gatherings has become so unpopular. I just think that people finally realized that, and that's probably helped push the market up a little bit in October, but there was a lot of fear in September, and we saw it too with travel bookings. For example, travel bookings were recovering quite nicely, and they really fell dramatically in September. Other market catalysts that were blamed were rising interest rates, especially on the 10-year Treasury. The 10-year Treasury went from about 1.2 up to about 1.6% over a few weeks in September, attributable a lot to inflation and the Fed. If you look at the 10-year Treasury, though, it started the quarter at 1.48% and ended the quarter at 1.52%. So it didn't move it a lot of up, and it's like on a roller coaster. Some up and downs during the quarter, but they attributed a lot of the market pullback in September to rising interest rates, where they thought it was going to keep going higher and higher, which I'll show you in a minute here, where I think it probably will, just not quite yet, not as fast as feared. That goes hand in hand with action from the Federal Reserve. It looks like, we'll talk more about this too, the Federal Reserve has talked about tapering their bond buying. So every month the Federal Reserve is going out and buying $120 billion worth of bonds in the open market to keep interest rates low and increase the money supply. Now they're looking at tapering that, and when they taper, they don't just quit. They're starting to slow that down over time. It looks like they're going to start doing that in the next couple of months, or what current projections are. And so that liquidity has been helping prop up the market. And so any thoughts of the Fed starting to taper, pull back those bond prices is hurting. They think that there'll be less liquidity in the market. Obviously, that's a negative. I like using the word wrangling. I used to live in Wyoming, so it's kind of a cowboy word. That if you look at what happened in Washington, that was affecting the market up and down. They were talking about the debt ceiling, the spending bills, the infrastructure, and then the social spending bills, back and forth. It seemed like anytime there was news, it was pushing the market up or down one way or another. At the end of the day, or over a longer period of time, I don't think that what happens in Washington affects the markets much, or shouldn't on a long-term basis, and that's kind of what we're seeing now. One of the other ones, stock price valuations, is people think that stocks are expensive. So there was a thought that, okay, everything's overpriced. If you think back to 2001, when we saw the tech bubble burst, stocks were crazy expensive, and a lot of these internet stocks weren't making anything, and they had these super crazy high valuations. And so there was, still is today, a lot of comparisons drawn to back then. And if you look, certain sectors, especially technology, are rather expensive. And if you look at the market as a whole, it is expensive, but not outrageously. The other thing to remember is everybody's looking at what's called the PE ratio, price to earnings ratio. So they're looking at the stock price, comparing it to the earnings of the previous 12 months. If you look at corporate earnings over the previous 12 months, and when 12 months was, that was in the middle of the pandemic. So some of these earnings were low, and they've since recovered. So as of today, the PE on the S&P 500 is sitting at about 30. Historically speaking, it's generally 16, 17, 18 is average, obviously a little bit above, a little bit below. But if you look at the forward PE, it's closer to 20. And so forward PE is just on what's projected going to happen in the next year, so it's much more in line. That being said, I think there are certain parts of the market that are overvalued, technology being one, and specifically certain names, but other parts of the market look relatively inexpensive. The Dow Jones Industrial Average, for example, which is only 30 stocks, the PE on that today is about 18, so it's right in line with historical norms. Lastly, the Chinese real estate, and this is a bigger question too, what's going on in China. The big thing that came out what was the Chinese real estate development company, Evergrande. And there's other ones as well. I might have mispronounced that. My apologies. And it's interesting. You look at what's happening in China. They keep just building this stuff. Here in the U.S., we say, okay, there's a need for apartment buildings, so we're going to build an apartment. But there, they just build it in hopes that people show up, and that's not always the case. These Chinese real estate companies are highly leveraged as well. A lot of banks have loaned them a lot of money, so when these projects don't work out, they're on the hook for a lot of money. So there was concern that the largest Chinese real estate development company was going to default on their debt. They've since worked it out. One of the concerns too was that this would just cause a bit of a domino effect like what we saw in 2008, where if they had problems, then all these other financial companies, these banks and lenders would have issues as well, and there'd be a huge effect in the broader economy, which might spill over into other parts of the world. At this point, countries outside of China have very little exposure to the Chinese market. That includes in the U.S. None of the large U.S. banks had any exposure to these real estate companies. A few of the private equity firms had a little bit, but it was real minimal. The other thing to look at too is if you look at revenues of the S&P 500, I saw a report that said total revenue of the S&P 500 based in China right now sits at 3 or 4%. I ran a different report of my own. It's closer to 8%, but either way, it's fairly limited exposure to the broader economy, especially here in the U.S. Now, some other countries might have larger exposure, but I think domestically, I don't want to say there's nothing to be concerned about, but it's probably not a real big deal. So that was quarter three. Quarter four, what are we looking at? To me, I think there's four drivers. Earnings, the economy, Fed, and then I keep putting Washington, I should call it Congress or politics. Earnings is, I think overall earnings is the largest driver of the market on a long-term basis, which makes sense. Any stock price, you're buying shares of a company to own it in hopes of future revenue, future earnings. And so that's why earnings are such a strong driver of the market. And if you look, there's a lot of seasonality in the market. Most September, the market's down. October, the market's up. Well, what happens? October is when earnings are released. There's no earnings releases in September. And so October so far looks pretty darn good. It's been a great month in the market. A lot of it's recovery. So far, 25% of companies, I should say in the S&P 500, have reported their earnings. About 13.5% have exceeded expectations, which is decent. It's down a little bit from quarter two and quarter one, but it's well over our 5-year average rate. And so as long as earnings continue to grow like they have, I think that's provides a lot of tailwind for the market. And earnings thus far are good. Now, again, it depends on which sector, what companies you're in. A lot of these travel stocks, for example, things look a little, travel bookings are down for your hotels, airlines, but other companies are coming out with pretty good earnings, especially in healthcare, some technology companies. So the outlook, so then the other part of this is the economy. So any company's earnings are really based on how well the economy is doing as well. They go hand in hand. There is the misnomer that the economy really drives the market, and there's oftentimes a disconnect. The economy can look real good and the market could be doing poorly and vice versa. So the economy doesn't drive the market as much as earnings does, but it certainly is a very big factor. And if we break down some of the bigger parts of the economy and what we're watching, so GDP growth is strong. I want to caution everybody about watching these headlines because GDP growth will come back 5.4%. Well, that's worse than last quarter. It's still great. It's still really good. We see that in some of the other economic releases as well. So GDP growth is still strong. It's come back a little bit from where it was, but it's still growing strongly. Retail sales are up quite a bit. They're still real strong. The reason I mentioned this is retail sales make up about 70% of the GDP. So this is something we really keep an eye on. How strong is the consumer? And along with that is consumer confidence. And your eyes aren't going bad here. This little arrow, instead of being up, it's slightly tilted to the right. It's a little lighter colored. Consumer confidence is still, I'd call it strong, but it's pulled back a little bit. And this is something that we're really watching. It's the consumer confidence surveys are a forward indicator of what retail sales will look like. And they've, consumers are a little concerned. Obviously, inflation's a big one. supply chain issues, which we'll talk about here in a second, leading to that. These retailers, things are great now, but they can't keep stuff on their shelves. I've anecdotally spoken with some small shop owners around town too, where they say, we'd be having the best year ever, but we cannot keep our shelves stocked. And people come in to buy something and they don't have it to sell it. You see it, in a larger space too. You walk into a Target or a grocery store and there's shelves of stuff that we just don't have. And my wife sends me to the grocery store. I come home, she's like, this isn't what I told you to buy. I'm like, I grabbed whatever I could here. This is going to have to work and substitute. Not to deviate too much, one of the funniest memes I saw on the internet, and I don't spend all my time watching memes on the internet, just about half, is it was a picture of Target, and just all the spice racks were just completely empty. It said, thanks a lot, Target, you ruined 600 years of great spice trade, or something like that, because it wasn't available. There's nothing left. And so that's going to have a weighing on consumer confidence, especially as we're coming up into the holidays here. I'm sure people have things on their mind that they want to be buying as gifts, and they may or may not be able to have access to them, which really, this is the first time in a number of generations, certainly within my generation, I would think probably going back to at least World War II, where we have shortages of some of the things that we've come to expect and maybe take for granted that we can just walk into a store and buy. Also, we watch jobs. The last 2 jobs reports have been a little weaker than expected, but still showing job growth. If you dig into the last jobs report, it showed fairly strong private payroll growth. But overall, the job growth wasn't as strong as expected because the public year government payrolls didn't grow. They actually lost jobs. We hit a little over a month ago, we were over 10 million job openings, so there's ample jobs available. They're just not necessarily being filled. That number's come down a little bit because these jobs are being filled out. The other thing that we watch is on a weekly basis, continuing jobless claims and the number of jobless people. Those numbers are slowly dropping, which shows more and more people are being employed. The unemployment rate is low. Everybody has a help wanted sign. So jobs are being created, but the growth maybe isn't as strong as what it is expected to be at this point. That, again, is why that arrow is tilted off and a little lighter colored. Lastly is inflation, which we're going to talk a lot about. That's why that's a big, bright red arrow going up. Good and bad. Not all inflation's bad. Speaking of the outlook, so again, the Fed, we talked about this a second ago. They anticipate to begin their tapering by the end of the year. So it's $120 billion per month. They haven't come into the specifics, but when they start to taper, it just means they won't be out buying $120 billion of bonds per month. Maybe it's 110. Don't quote me on any numbers. Until at some point it finally ends. This is also known as quantitative easing. This happened back in 2017, where they done it to add liquidity in the system, and then they stopped it. This is also a good sign because it shows the Fed thinks that the economy is on stable footing on its own. They don't need to prop it up any longer. So there's some positives to this. The other part of the Fed is that current forecasts call for 1 interest rate hike in 2022. Depending on what happens with inflation, that could be more. Now this is the Fed funds rate, so the very short term, which is currently targeted between 0 and 0.25%. Short term, the Fed has done such a good job of telegraphing what they plan to do that generally speaking, when these rate hikes occur, it's not a surprise. So I don't think that the Fed, whatever they do, is really going to surprise the market much and have an impact on, and when I say market, I mean the stock market, whether it moves up or down. And that's the capital with a nice lightning bolt, because obviously the fiscal policy will come into this too. They're still discussing the spending bills, the infrastructure, and the other spending, what we'll call a social program bill. Original price tag was $3.5 billion. Current talk is that they have it brought down to about 1.75, or not billion, trillion. Sorry, left to fill a few zeros up. Yeah, just ask the president. It costs nothing. And that's where there's real question on this. Some government spending, if it's used in the right way, is good for the economy. If it's being wasted, it's not. But then it has to be paid for. So if it's debt, the debt is going to be a drag on future economic growth, or it has to be paid for in taxes, which also can be a drag on economic growth. And that's why we're so unclear on tax. Taxes are sitting at the lowest rates they've ever been, so it seems inevitable that taxes have to be raised regardless of what we're being told or not. In the details coming out, they think that they have an agreement made where they can vote on these this week, but there's no details on the taxes and the revenue really, minus, yeah, we're going to raise taxes for some people. So I think the whole tax thing in itself could have a potential to harm the market or cause some volatility. Any debate going back and forth, probably not so much. The other big thing was the debt ceiling. You read the headlines, U.S. is going to default on their bonds. That's never going to happen. I mean, these two parties don't agree, but at the end of the day, neither one of them, it's not in their best interest to let the U.S. government default on their debt. So they did come to a short-term agreement, to kick the can down the road through December. We'll probably see headlines again saying that they can't figure it out. The U.S. might default, but they'll get it figured out, and it could cause some short-term volatility in the market. But big impact. If I'm wrong, it'd be disastrous for the market and be pretty ugly. But our politicians come to their wits and senses and figure this stuff out. So as far as inflation goes, and this is really the biggest theme in the market right now. Came in this morning and there was a number of headlines from over the weekend talking about inflation. There's supply chain issues, the 100 ships sitting off the port of Long Beach or whatever, full of these things that can't get onto shore, and then even once they are on shore, there's nobody to drive the trucks to get them to where they need to be. So that's causing inflation because people are buying what they can, willing to pay more and more. Yellen, so that's Treasury Secretary Janet Yellen, says she expects inflation to run through mid-2022. If you think about this, and she used to be, she was, or Jerome Powell, yeah, thank you, too. But so she's not with the Fed any longer. So she still knows what she's talking about, but the Fed has talked about how inflation's transitory, and Jerome Powell has come out and said, well, maybe not so much, maybe it is a little bit longer. And they keep pushing this out further and further. So for her, again, not part of the Fed, but still part of the government, says mid-2022, that's out quite a ways from where it has been. So there's finally some acknowledgement that there is inflationary pressures in the market. And then there's another headline from the Financial Times. And inflation's a real threat to consumer spending and earnings. So that's really if we're talking about risks in the market, that's, in my eyes, the biggest risk that we see right now is consumer spending being affected by inflationary pressure, and then supply chain, just lack of goods. Just to recap on inflation too, the very basic definition of inflation is too much money chasing too few goods. So if we look at the money supply, this is from my friend Fred. This is the St. Louis Fed, has all these charts. Fred, so if you ever just Google it, you can find charts on anything, I think. So it's not the prettiest to look at, but I have to give them, credit for providing the information. This is the money supply. So thanks to the bond buying, all the stimulus packages, this is the amount of money in circulation. What I find fascinating is you go back to 2008, and you remember how everybody was throwing a fit about all the money that was used to prop up the banks and bail them out. That's a blip on this compared to what we're looking at now. And so there's been a huge amount of money put into the system, which is going to push inflation. Probably years to come, and obviously the numbers, climbing too. And if they pass these spending bills, it's going to be even larger. So those are, just for scaling over there, it says billions of dollars. So basically would be 22 trillion at the top, but you add 3 or 4 trillion on top of that, and this number goes up pretty quickly. So one of the concerns with inflation is what will happen to yields of bonds. Like I was talking about before, bonds have traditionally been used as a hedge against equities sometimes to provide some stability. It can also provide income. Bond yields are so low, there isn't much income being provided right now. And we're coming off of what's been a 40-year run, bull run in the bond market as interest rates have come lower. But here, if you look, so the red line is CPI, so that's inflation. And I apologize, I see some of you nodding your head, some of you more engineering, science types are like, yeah, I love these charts and numbers. For the rest of you, you're probably half asleep, so my apologies. I think charts show great pictures though. So the red line is inflation measured by CPI, it's year over year change. And the blue line is the 10-year US Treasury, where you can see over the last 10 years, they've tracked fairly closely. Kind of deviated a bit going back a couple of years, but have been close. But you see where inflation's gone and where the Treasury's gone. Chances are the 10-year US Treasury has to move up quite a bit, which would really have an impact on bond prices. This is another chart. So this is showing the PCE, personal consumption expenditures. This is the Fed's preferred measure of inflation. And so they say they target 2%, and they've recently come out and said, okay, we're comfortable with 3%. It's running pretty close to 4%, and this is the Fed funds rate. Chances are they're going to have to raise rates, and probably quicker than we thought, or what we're expecting, unless this comes down. And I mean, you can see here where there's been some blips in the past where it has come down and seems to be under control. But if the Fed loses control of inflation, we could see that Fed funds rate move up very quickly. I wanted to use this visualization. Many of you have probably seen it. This just shows the relationship between bond prices and bond yields. So I was talking about bond yields moving higher, while bond prices move lower. So a few of these in a portfolio, if you own a bond and the yield moves up, your price is going to move down. And that's what we saw in the month of September in the market, is bonds lost value because yields went up. So bond prices went down, and it was not providing the hedge against equities that we've seen traditionally. All right, how are we doing on time? So as far as portfolio positioning goes, these are our portfolio strategies. This is getting into, some of the nuts and bolts of the portfolios that we manage here at Secured Retirement. We have really 4 ETF portfolios. Our all-weather, which stays pretty much the same, pretty static. We don't change that one a whole lot. Then our moderate growth and aggressive, and as the names imply, the aggressive is the most aggressive, where the moderate's real middle of the road. And you can see our current allocations across the spectrum. We are outside of the all-weather, which we're going to visit. That's supposed to be one that we really don't touch hardly ever. We're going to revisit that though and look at the fixed income, just because of what we think fixed income is going to do. Find other vehicles that we think would provide better hedges against equity, a little more stability, if not a little bit more income. On our other ones, we don't have a lot of fixed income for the reasons I've mentioned. We don't think that it provides the diversification, certainly not the yield that it has. On the equities, we do have a little bit of exposure to foreign and emerging markets. We don't think that the foreign developed anyhow, so that'd be your Europe, Japan, Australia companies. We don't think that those will probably perform as well as the markets going forward. Our allocation that we currently hold is less than what a benchmark would be, like the MSCI All Country World Index. We'll probably even be pulling that back a little bit further. In Europe, there's a lot of demographics going on. They have an aging population. They don't have the younger people to come in and take their place like we do here in the US or Asia. So there's also a lot of government regulation. Their banks are highly regulated as well. So we're just not as hot on the foreign markets as years past. Emerging markets, like I'd mentioned, we have a real small allocation. I actually think that those are going to recover at some point and do well. And we've seen that in October a little bit. They've recovered somewhat as some of these countries have gotten their COVID cases under control and rolled out more of the vaccine. And I think we're going to see a continuation of that recovery outside of China. But you look at India, for example, is a great example of a country that really is opening up. There are a lot of growth. They have a great population story. I don't know if I should call it great, but they have a large population supposed to overtake China in the next 10 or 15 years. We do have some hedged equity as well to protect against the ups and downs in the market. And then we do have an allocation to commodities or real assets. Just with inflation, raw materials and commodities tend to do quite well. That has worked out well for us. And a little bit of cash too, should we see a pullback in the market. On our core equity, this shows our allocation versus the S&P 500 at a sector level. We are underweight technology. Like I said, I think technology is still rather expensive. Overweight healthcare, which has worked out well for us. A lot of the healthcare stocks have done quite well. We're also overweight materials and energy, and that's a large inflation play as well. getting back and asking, okay, what's the best way to protect against inflation in a portfolio? If you look back to the 70s, what did the very best was small cap stocks. And gold happened to do well back then too, but there's some other factors going on that are not present today. We won't spend a lot of time on that. And the other thing that does best against inflation would be large cap stocks, especially when you look at materials, energy, to some extent real estate. You have to be rather selective in the real estate area. We think industrials could do well if they pass the infrastructure bill. That's our current positioning. We talk about our returns a little bit. For the quarter, so our healthcare did quite well. Our technology did decent. It was lagged the benchmark a little bit because technology did do quite well third quarter. Now technology's pulled back a little bit in October. Our finance did well. We own a couple of names there, Blackstone and PayPal, that really helped. So one thing, as a portfolio manager, you need to remain humble because a lot of times the market moves in the direction you want it to and you look pretty smart. It's not a question of if, but when the market moves against you, you don't look so smart, so you don't want to brag too much. But, so on 9/20, which it was a Monday, doesn't make any difference, I went in and made some changes to our core equity portfolio. The market was down quite a bit. Thought it was a good day to go, and I found a stock called Synopsys, it's a little smaller company, not huge. They're part of the S&P 500. It's a tech company. They do a lot of software work for integrated circuit boards. It's very fascinating. Google them if you want. So I bought that at about $317 a share on the 20th of September, and right after that it did what it normally does and went straight down and dipped down to about 280, down to 270. Was looking pretty darn bad, and Joe Lucy's like, "What, you idiot? You're not supposed to, what are you supposed to be doing?" It since has recovered. It's at 325 today. But the day I went in, we rebalanced all the accounts, and here's really where it paid off for us. And so all these things that were trading much lower, so we rebalanced and bought into those. We sold or trimmed our winners. We really didn't sell anything, and bought some of the losers just by pure rebalancing. And it worked out quite well for us. So we added money to our energy names. So these were the top 5 worst performers for the quarter up through the 20th, and then from the 20th up through last Friday, they've been the best performers. We added a little bit too. You can see it to Freeport Mac, Copper Company. So the rebalancing of the day wasn't going in and buying the particular stock. It was just rebalancing the whole portfolio, and we did the same thing on the core equity, or our ETF models as well. We did a little bit of that was just more of a straight rebalance. So what we ended up doing is buying into a little bit more of the 4, and I did reduce our hedged equity, buy into the domestic equity, and that's worked out pretty well. That's really all I have. Are there any questions? I did a lot of talking. Seems like very quickly. Any questions, thoughts? Yes, sir.
With 10 million jobs open, and a lot of those jobs are truck drivers, and that's really the big problem we have with supply chain. They've got the major ports willing to work around the clock, but there's no place to put the stuff that take off ships. Why can't we get people to be truck drivers anymore? That's
a good question. And I think for the younger generation, they're not as willing to work. And truck driving is something that takes a little bit of training. It's not extensive, but it's not something where you can just put somebody into the seat and have them do it. They have to go to school, get their CDL licenses. But yeah, it's a great question because it's a decent job. They pay pretty well. I don't want to say it's easy by any means, but outside of that training, you get in a truck and you drive. I wish I had an answer to that question for you. There's a lot of open jobs. I agree. I fully agree with that. Yeah, my granddad was a truck driver, so I'm biased and think that people should be out driving trucks. Solve a lot of our problems. I think people now, I think part of our problem is, especially with the younger generation, so it's older, and when I say us, I kind of group us all into the same category here. We've used to always been working to do whatever it takes, to get through life. I think this younger generation, when I say young, I mean the real young people that have been receiving stimulus checks for the last year and a half, become reliant upon that and maybe aren't as willing to work as they should be. But that. Sir?
I noticed you were a little bit underweighted on the financials. Do you see that when interest rates eventually do start rising, that the banks as they are, they're probably going to come out well? So I just noticed that you were a little bit underweight, at least in your core equity.
Yeah, and originally we're underweight. I think that the traditional banking models may be a little broken. I mean, not a lot of people go into branches, and if you look at what banks do, there's not a lot of margin in that. But I will say in the month of October, I've been wrong to been underweight because the banks have done quite well. With interest rates rising, you see the net interest margin expanding as well. So absolutely, and it's something that we're taking a look at. My thought, some of these smaller, or I should call them the mid-sized regional banks have been doing well lately, and I think there's some opportunity. Probably a next addition into our portfolio. If I look at just the month of October, that's the one area where we've been a little bit behind. Good question.
So, trying to interpret some of your previous comments. So, when you're restricted to generalized investments in a 401k, all right, as a inflation hedge, it sounds like maybe large cap value might be a good choice, or what are your thoughts there?
Yeah, large cap value, because you look, it's the materials, industrial companies that tend to do best, which generally fall into the value space. Small caps also tend to do real well. Now, don't load up on small caps. Like I said, I'm not giving any specific investment advice, but I've seen people go out and do half their portfolio in small cap stocks, and it's not advisable.
Break out of
It looks like it.
year-long channel.
I think small caps will do well. So yeah, I'd look large cap value, small caps for sure, some mid caps. And I think a lot of it too is there's always a rotation between growth and value. And with the technology companies, which are traditionally growth, being a little overvalued, I think we're going to see more of a rotation into value over the next year. My guess. Happened earlier this year for a quarter or two, then went back to the growth. I think we might be seeing a change there. I think commodities are generally a decent investment. Oil prices or natural gas are crazy. I don't know how much higher they'll go, but look at it, our supply is very limited right now. That's a major factor in pushing these energy prices higher. And then, of course, the raw materials, to copper. Everybody heard the lumber stories where lumber went up 3 times what it was selling for pre-pandemic, and then it's since gone down. Any other questions, comments? Certainly open to feedback. If anybody has any disagreements or anything I missed. Yes, sir.
Can you tell us something? The difference between the ETS and the mutual fund, are they similar, or what kind of
Yeah, so
advantages are there?
no, good question. So ETF stands for exchange traded fund. So it's like a regular mutual fund. You go out and you buy shares, and at the end of the day, they price it. You buy however many number of shares that is, or you sell at that same price. With mutual funds too, they have different expenses. So there's a management fee associated with it. Sometimes there's a distribution fee, as they'll call it. Some mutual funds have like an upfront load or a back-end load. With an exchange-traded fund, it trades on the exchange, so you can buy and sell at any time during the day. They don't have any of the back-end loads, the front-end loads. They do have a management fee, depending on which one it is. A lot of times those are extremely low. Yeah. So from a cost perspective, they tend to be better, and then a lot of times too, just the liquidity, being able to buy and sell. Otherwise, generally speaking, they own a basket of stocks or bonds or whatever, and they're.
What do you foresee, at least for this quarter, other than energy? What else? What other sectors you think is a better prospects?
Yeah, so healthcare has been real strong so far, and I think that'll.
Not for the last quarter.
But I'm looking like October.
Okay.
Yeah, going forward.
Yeah.
Healthcare, I think industrials will probably, come back into play quite a bit. A lot of those are very reasonably valued. Some of the consumer stuff is a head scratcher. I'm a little saying this, knowing that we have Costco, Target, TJ Maxx or TJX. in our portfolio, be a little bit leery of some of the retailers, just because I'm not sure the holiday season is going to be as strong as it has in the past. I'm not sure that they can pass along all the price increases. So I would be looking more for the raw goods producers, your materials, steel makers, for example, industrials.
If energy prices decrease, will transportation stocks respond to that?
I would think so, because it would lower their input costs, obviously. And you know, when you say transportation stocks, I assume that you're referring to like trucking companies, not airlines and things like that. I sold airlines too. Yeah, it certainly would provide a nice tailwind for those stocks. As we were talking a second ago, though, you know, the trucking companies have some labor issues, just people being able to drive the truck. Yeah, but, you know, if that bottleneck ever breaks free, I think transportation companies could be a great place to be.
Well, the West Coast, as I understand it, you know, there's ports all up and down the West Coast.
Right.
But it happens to be those two, LA and Long Beach, that are way backed up. And I believe California passed a number of initiatives to help the Uber drivers that affected everybody, and it was independent drivers kind of got shunned away from the industry, as I understand it. And it caused an artificial lack of supply, decrease in supply of drivers out there. I don't believe around the country other ports are backed up quite like California's. And of course they import 60% of what the country gets because it's coming from China. I haven't heard anything about California passing more legislation to fix the problem, but I think there are ways around this to increase the supply of the drivers. You know, as I understand, it's an artificial lack of supply just because of what they've done out there, and then restrictions on trucks also. Older trucks, because they pollute more, aren't being allowed to drive.
That certainly is another issue, too, is just having the machinery, the actual trucks themselves available. That's, you know, getting onto this too, it's interesting, and I'm kind of going down on a tangent here. I don't know if anybody's been shopping for a car lately. Some of these car lots are empty. I drove past some just over this weekend, and I was surprised. And some look all right, and other ones, you're like, there's nothing there, unless they're having some off-site sale that I'm unaware of. My wife was getting the oil changed in her car last week, and you know, she overheard a couple come in, you know, slap down the cash. We're ready to buy the car. Let's do it. Great. We'll have something for you in December. I mean, it's tough, I think.
The lack of chips.
Right.
That backed them up. It held back 80% of the production from Indian plants. I've talked to Jeff Belzer down in Lakeville.
Okay.
And he normally gets 45 semi-loads of cars in a week at that Chevy dealership.
Wow.
The Chevy, Dodge, and Kia. He was down to getting 4. And so he was completely empty. His prior Lake dealerships, no different. Can't get them. They're finally starting to flow. And so I think we'll see the car lots starting to fill back up. But when it takes over 350 microchips to build a car today, for a normal car, without all of the whistles and bells that you get, and you can't get any chips, there's a lot of work to do to finish building that car once you put them all in.
Absolutely. Yeah, that certainly has been a real bottleneck for the cars, is these chips. And it's funny because, you know, in my mind, when I first thought of this, I thought, oh, there's got to be some chip in the engine. You take the car and they plug it in. Well, there's chips in, you know, your power seat and stuff. All these things have chips in them. And you're right. And if they're missing, then they're stopped. And you hear about shutdowns on some of these assembly lines.
Well, if you've got power seats with electric seats, you probably have 3 chips under each seat, because you got one for the cooling fan, one for the heating coils, and one for moving it around.
Right. Yeah. It's just one small part. Yeah. I don't know. Yeah. Then start stealing my thoughts on cars and, you know, thoughts on that market too as they transition to electricity. Say that for different.
Just a comment on that, as they do change to electricity, a lot of the country experiences rolling brownouts and blackouts. Okay, and you can't charge your car in those conditions.
They only let you charge car between daylight, sunlight and sunset.
Okay, so you don't get any house lights tonight, you wanna charge your car. But, I mean, investment opportunities there on energy production and I know it's hard to see 10 years down the road, but, we're not building a whole lot of power plants around the country. Can that change? You know, is there investment opportunities there?
They won't let them build nuclear, they won't let them burn coal anymore, which means they're gonna burn natural gas to drive up your heating bill even further.
Well, there isn't any natural gas prices.
There's only so much you're gonna generate from solar and wind.
Yeah, that's, I don't wanna call it dirty, it's very inefficient.
Right.
Power too. Well, and getting into China, so they have a big push in China for electric cars, but all their power plants are coal. Yeah, so it is natural gas. They are supposedly doing some nuclear in certain parts of the country, but that's not something where you flip a switch and it just happens overnight. As far as investment opportunities go, there's a lot of the engineering firms that would do that, the construction companies, some of the infrastructure, to a certain extent raw materials as well, I suppose. That's, a lot of the same companies that would be involved with an infrastructure type. There certainly is going to be a demand. I don't want to share my personal thoughts too much. I'm an electrical engineer by training, so I like electricity. I go visit my folks in South Dakota, and if I have an electric car, I'd have to stop twice. And those things don't charge very quickly. It would turn my 8-hour trip into about a 12-hour. So that's just me, this is one person. I'm not real excited to go out and buy one myself. And I see that they're mandating these in California by whatever year. If you're traveling any length, and maybe they charge more. And I know that they've helped with the technology and it's supposed to be faster and better, more charging stations, but it just seems to me like for any long road trip that they're probably not.
They sell the option of a trailer with a diesel generator in it that you can plug into your electric car.
And pull that behind you. Charge it as you're going. Fascinating technology. I think I've spewed enough of my personal. Any other questions, comments, thoughts? Really want to thank you all for coming, being very interactive. I appreciate that. If there are questions, don't hesitate to let us get home and think about something and think I'm way off. Don't hesitate to call me out on it either. This is memorialized and recorded, so we can look at this in 6 months and see if I had half a clue what I was talking about or if I was. The market looks good and things are good. I talk about seasonality quite a bit too. September is always the worst month for the market. October, November, December, generally pretty good months. So hoping that it ends up being a pretty decent. Thank you all. Enjoy the rest of your day.
Thank you.
Thank you.